Hi everyone, I'm Ken from Crypto Trading KS and the inventor of the CTKS method, the world's most powerful system for detecting smart money buy and sell levels. Today we're going to talk about the markets, timing, and the trading/investment mindset. If you're new, a very warm welcome and welcome back CTKS family. Please smash that like button, subscribe, and turn on notifications to know where smart money is buying and selling. And to also get into more synchronization with the market. Let's run the numbers. Rule 600. Traders are always taking profit. It's important to recognize that traders are all about timing the market. Investors are all about time in the market. They're two different focuses. Traders are always seeking to get on the right side of the percentage. That's why they use Rule 621. Buy on red, sell on green. And there's Borsog, the price eagle, screeching away, saying, that's important. Get on the right side of the percentage. Buy on red, sell on green is a professional mindset. It's not a retail mindset. Unfortunately, 9 out of 10 people have this retail mindset. When the markets go green, they get all excited. When the professionals see the markets go green, they're actually scaling out. Professionals are not news focused. They understand the news, they read it, absolutely, but they're independent. They use the market's pulse to tell them what the news actually is. How does a professional let the charts tell them the news? When we looked at total crypto market capitalization in the last video, what did we see? Turning on the CTKS method monthly service indicator, we saw that the total crypto market cap around 1.153 trillion, it was coming into resistance. What did that mean? When you're getting a resistance level, you're likely to get rejected from it. Not always, of course. Sometimes price can go flat and trade above. We must take particular note of resistance levels, especially strong ones. And what happens when a market is coming into support? It typically bounces, not always, but typically so. We have to stack our probabilities. What happened in the market in the past 24 hours? We saw total crypto market cap hit that resistance and then bounce down to its support. We know that inside financial markets, by using the CTKS method, these lines called Stanfield levels, we know that price as an aggregate is always moving between an SL and an SL, between an SL and an SL. What does that mean? It gives us a degree of certainty. It allows us to stack probabilities. A lot of people were feeling that the crypto market could only go into the heavens. After all, there's so many fantastic news stories out there. Professionals are very mindful of those news stories, but they're also more mindful of market structure. And that's exactly what the CTKS method reveals. It reveals where smart money are buying and smart money are selling. We know that all investors become traders anytime they buy or sell. As an investor, you don't want to buy at a resistance level. You want to buy at a support level. The difference can be astronomical in terms of returns. There are many incredibly good projects out there, and I'll just explain how XRP went when it hit market resistance. XRP had some really good news, but you find that a lot of these projects are having really good news at the moment. Fantastic for Ripple. It just got an authorization from the Monetary Authority of Singapore. And what happened as the market got into Ripple got into market-wide resistance, you can see that it came down. And where did it come down to? That's the question. What would happen if an investor got in up here? Well, that's fair enough, because investors like to hold for the long term. But imagine if you got in down here, you're getting on the right side of the percentage and overcoming around a 7% loss. This is where a knowledge of how market structure impacts your charts is really, really important. If you're looking at price action without the CTKS method, it's really difficult to know where the ceilings are and where the safety nets are. But to pop on your indicator, you can see that there was a raft of safety nets from around the 49.17 mark up to the 49.81 mark. If price came down, it was very likely to get caught, slowed, stopped, and reversed by all these safety nets. That's what price actually does. Inside the masterclass, we have so many ways of layering into positions. We never go all in at one particular level because that would be crazy. Price is always moving in waves, and we never buy at market. Frederick, a graduate of the masterclass, said, "It's absolutely the best class I have ever taken. You transfer knowledge in a very effective and fun way, and your teachings are structured beautifully. Skill and knowledge is methodologically built from the ground up like a house. There are a number of sections inside the masterclass: the foundation, the trend, the timing, the trigger, and the real wealth section. Having lectured first and second year statistics for many years, I understand how to take a very complex subject and make it relatively simple, just giving you what you need when you need it, just-in-time knowledge. Many people, when they're new in financial markets, they want to buy and sell first up without the foundations, without understanding how the markets work, without understanding how to find the market's focus and how to position yourself from an emotional and intellectual level. Buying and selling will unfortunately backfire. Getting rid of FOMO is incredibly important. How do you get rid of FOMO? You need to get synchronized in with the market. The Tier 1 charts are vitally important. They are the engine, the powerhouse of global markets. Tier 2 and Tier 3 are important as well. I would suggest that you look through Tier 1, Tier 2 and Tier 3 on a daily basis. Why is that? Because the market pays you on your synchronization. If you're synchronized, the market pays you. If you're desynchronized, you pay the market. It takes time to get synchronized in with the market because a lot of people get emotionally swept up. Professionals do not get emotionally swept up. They seek to participate when price is below resistance and then stack when price is coming back to support. One thing with the crypto market, there is a lot of positive bullish momentum around right now, and we expect that to continue into the future. These times where price comes back, it's just a fantastic time to rescale in or add to your position. And note that things could get a little bit choppy, so don't expect just clear sailing. That's not the way financial markets operate. One thing just to keep in mind, the 24-hour liquidations are not substantial at the moment. It's quite suppressed actually. We're seeing fairly low volumes inside the crypto market, 118.54 million in total liquidations across 44,119 positions, and total liquidations across the past 24 hours, about 57% long. What about the past 12 hours? 73% long. Past 4 hours, 60% long. And the past hour, nearly 85% long. What can we see? The past couple of days, the shorts were getting really heavily hit, and now the longs are starting to get the other end of the stick. The greatest gainers in the past 24 hours, Peppy up in front, showing a lot of pep in a peppy step, followed by Conflux, AGIX, Leo, SHIB, Mina, VET, XMR, and XDC. The greatest losers, top 100 past 24 hours, Render, Stacks, Flow, Mask, Carver, Optimism, Neo, Zek, and Trust Wallet. The CTKS method applies to any price chart. It doesn't matter what you're looking at. Commodities, Forex, crypto, stocks, indices, they all obey the CTKS method. When looking at the S&P 500, the CTKS method is applied from the inception of price history. In this case, for the S&P 500, that's 1871. Retail, when they mark up a chart, they'll only look at recent indicative price, or RIP. Without an understanding of long-term structure, RIP will RIP your money. So what are we looking at with the S&P 500? Let's turn on the indicator from the monthly service. We can see that recently the S&P 500 came into really stiff smart money sell resistance from that 44.35 mark up. Where was it coming down to? Smart money support levels. You can say that when you get a smart money sell level, it's saying, "You shall not pass." Just like Gandalf out of Lord of the Rings. And when price comes down to smart money buy areas, especially when they're all hanging out together. Cue the Cyndi Lauper song, "If you fall, I will catch you. I will be waiting." Time after time. Who said that market analysis can't be fun? So what you're looking at is a ceiling and a floor. The heavier the floor structure, the greater the probability of bouncing from that particular structure. And that's what the S&P 500 is doing right now. Without an understanding of market structure, or specifically objective dynamic market structure, from the CTKS method, you would look at price when it's coming down like this and say, oh no, the S&P 500 is going to fall through the floor. No, it's going to fall through a Stanfield level and get caught there and rebound. It will be waiting. Look at the difference in analysis when you know where the smart money levels are. It's a completely different way. It's stressless investing and trading. The beautiful thing is that you can learn the CTKS method, and learning the CTKS method is like putting money into your bank account, because when you look at something like this, a lot of people would say, oh my goodness, price just crashed down. Why did it do that? Students of the CTKS method say something else entirely. They say, I know that there was a fresh air gap there. There was a rejection of upward resistance, and it didn't get above that resistance and turn it to support. How can we actually see this? Well, we just pop the indicator on, and this is gold marked up from 1833. Financial markets always have climactic sell-offs. When there is a climactic sell-off, what happens to these safety nets? They get passed through, but the more of them there are, and the stronger they are, the more price will be gravitationally pulled back to them. And we can see that's exactly what happened with gold. Inside the masterclass, we talk about negative air and positive air. They're very, very powerful concepts to adapt to. Students also know Rule 446 is incredibly important. All markets are intercorrelated and interdependent. Looking at the DXY, recently it was coming down and down and down. Now it's started to come back up. Why is that? Because the Fed has said, ooh, we're going to increase rates 2 more times. And if you are looking at the intro, you can see the federal funds rate, the probability of a 25 basis point increase at the next FOMC meeting is up around the 80% mark. And there's 34 days to go. The markets are responding to this. But could we have seen this structure? Could we preempt the move in the DXY? It largely depends on smart money, support and resistance. So let's throw on our indicator. We saw that the DXY was having a lot of trouble getting through upwards resistance above that 102.7222 mark. But we did note there were safety nets below. Cyndi Lauper was coming in saying, I'll catch you. If you fall, I'll catch you. I'll be waiting. And she certainly was. Oh, who knew that Cyndi Lauper was a financial analyst? We can now see that the DXY is being positively supported at the moment. Where is it going to next? The DXY is currently 102.3950. It has smart money resistance above at 102.59. 18. And what is this? This is a Gandalf level. Gandalf is saying, you shall not pass, but he's a pretty weak Gandalf. The higher level is a little bit more strong. He's more strongly worded up there at 102.7356. It looks like it's a battle between Cyndi Lauper and Gandalf, and we can see down below we've got a smart money buy area at 102.2081 and 102.1748. When you're a member of the CTKS Method service, you have all of these indicators and a video on each specific chart. You've got an indicator and also the three-dimensional risk management inside the video. You can figure out where price is likely to go. There are currently 25 videos on this method service, and there are more to come. For example, with the approval of the EDX exchange, which is basically an institutional traditional finance exchange, pushing Bitcoin, Ethereum, Litecoin, and Bitcoin Cash. Litecoin and Bitcoin Cash need to be added to the service because they have institutional interest. And when we look at the EDX press release for that exchange, they're basically saying Bitcoin Cash, Litecoin, ETH, and Bitcoin are not securities. They would not fall under the SEC's purview. Purview, what a cute name for Gary Gensler. Over the next couple of days, that Litecoin and Bitcoin Cash video and indicator will be released. Just for your information at the moment, we have smart money resistance at that 87,620 level for Litecoin, and also smart money buy areas at 84,095 and 83,951. Litecoin is currently 85,550. When looking at Bitcoin Cash, you can see Bitcoin Cash had some really unusual price behavior. It spiked and then backed off. Can smart money explain this backing off and those spikes? Yes, it can. Having a look at Bitcoin Cash, when we pop on the indicator, what do we see up here at around that 149.27 mark? A lot of resistance. You can see Bitcoin Cash absolutely went for it. And inside the service, I'll explain why it did this. What happens when we meet strong resistance in the market? This is a strong Gandalf level. Gandalf will say, thou shall not pass, and push price down. What do we look for? A confluence of smart money buy areas. And you should also bear in mind that if you're only trading the chart that you put money into, you're making a huge mistake. You need to look at as many charts as you possibly can to get the flow and the feeling of the market. One thing that we saw, there was a lot of smart money support between that 133.44 level and that 134.53 level. As a result, when price came down climactically, we would anticipate it could go a little bit lower, and it did so, and it reached that 129.77 mark. But understanding that that resistance was inside the market is a very good thing to know, because what happens when you get resistance? The price comes down. We can see it all the time. This is normal. When Bitcoin Cash was just exploding upwards, retail was FOMOing in, fear of missing out. The unfortunate thing, when you're hitting a level of structural smart money resistance, thou shall not pass is a really good way of looking at it. What happened to Bitcoin Cash from there? It came down nearly 14%. What would a lot of people do? They would probably go all in and more at one particular level with a lot of leverage. And what would be the result? They wouldn't lose 14%, they would lose multiples of 14% and maybe even blow up their account. By the time it got down to this level, they would say, oh no, I read it incorrectly, I need to get out, and they would sell. After they would have sold on this capitulation spike, because that's exactly what it is. That's a capitulation spike. The price went up because it simply ran out of sellers. And they would say, oh no, I read it wrong. I should get back in. And they get on the wrong side of the trade again. And they would probably sell when they see it coming down. You can see that the retail mindset is just a disastrous mindset, but people aren't taught any better. It takes decades inside financial markets to understand this crazy psychology. One very, very easy and fast way to escape the retail mindset is to simply become a member of the CTKS Method service. Each month you will see where smart money is buying and selling. Please put in the work. Don't only trade and don't only look at the particular chart that you're interested in. You will find the tier 1 charts drive financial markets. You want to be a professional. That means you have to take it seriously. After all, you're putting your hard-earned money in. You may as well put the effort to go with that. You can think about anything that you've been wildly successful at inside your life. You would have had persistence, commitment. You would have been capable of being humble and learning. You would have been kind to yourself along the path, but kept on keeping on all the time because that's what you need to do to be successful in anything. Always keep Rule 603 in your mind. Synchronization profits. This is the key rule that you need to understand. When you are synchronized in with financial markets, the markets will pay you. Other people never pay you. The market pays you. When you lose money, you're not paying money to other people. You're paying money to the market. Therefore, there's no guilt in profits and no shame in losses. A lot of people say, oh no, it's a zero-sum game. You know, like selling your car. Like if you sell a car to someone, they're losing and you're gaining. Well, I hope not. Or if you're selling anything to another person, by the case that you are making money, the other person is, of course, losing money. Oh, are they losing money? Well, let me know in the comments. As part of our creed, we win or learn and never blame. Why don't we blame? Blame is the easiest thing to do. It can't be our fault. It has to be somebody else's. But if it's somebody else's fault, you don't have control over your own outcomes. Therefore, blame is incredibly disempowering. Therefore, we learn instead of blaming. Blaming is just the biggest waste of time you can ever get engaged in. Don't think about what happened. Think about what you learned. And we have dedication and commitment. It doesn't matter if we get a setback. We laugh at setbacks. That setback is a setup for our next life rally. The CTKS Masterclass is more than 30 years of knowledge transfer on how to look at the markets with a smart money mindset. I'm currently offering the Ken Stanfield CTKS Partial Masterclass Scholarship Award. By showing your positive excellence, your dedication and commitment, and also applying through the link in the description of this video, you can become eligible for this partial masterclass scholarship. Have a great day or night ahead, my friends, and Kate and I look forward to catching up with you again tomorrow. Bye for now.